Now, Patrick Chovanec is a professor at Tsinghua University School of Economics and Management in Beijing, where he teaches on the International MBA program. He used to be involved in private equity and still advises funds and corporations, and was once a Washington apparatchik. He joins us now live from Beijing. Professor, welcome to the program.
Good to be with you.
Now let's go first to the sovereign wealth fund buybacks. It now has controlling shareholdings in the banks, the wealth fund, and you've described this process as similar to a share buyback. Is it anything more, though, than a confidence trick?
Well, the normal rationale for a share buyback is that the stock is undervalued. And the key question here is it really undervalued, or are they trying to head fake the market? You know, in my view, those shares aren't undervalued. There are real problems with the banks. The Beijing authorities know that, and they're trying to boost the price to keep the window open for these banks to access domestic and foreign capital. They want to tap into capital markets to refund themselves, knowing that they have losses that need to be plugged, rather than having the government do it. So this is the controlling shareholder trying to put in a little bit of money to boost confidence to keep the game going.
Is it going to work?
I don't think it's going to work, because really the market has already begun to realize that there are problems with the banks, that the banks have lent too aggressively. They often lent towards projects that aren't going to pay back, and these banks are going to need to be bailed out. Now, the question is, are investors going to bail them out, believing all the numbers that are coming out from the banks about record earnings? Or are they starting to get skeptical? And they are starting to get skeptical, and ultimately the Chinese government's going to have to step in and bail them out.
Tell me about the change in the quality of financing across China, this shadow banking system, and a possible $15 billion bailout of the business hub of the city of Wenzhou, which has been described as funded in some cases by Ponzi schemes.
Well, to understand what's going on, you've got to look at what has been driving the high levels of growth, 9–10% GDP growth over the past 2 years in the face of the global economic crisis. China essentially did that by pumping its economy full of money. That money went out in the form of a lending boom to fund an investment boom. And that raises two problems. First of all, a lot of that money went into bad investments that won't be paid back. And the money supply has expanded dramatically by 2/3, actually. China's money supply has expanded by 2/3 since November of 2008, and that has translated into inflation. And so the government, the central bank in particular, has been trying to rein in inflation by tightening up this easy credit. But this easy credit's fueling a lot of the growth in the economy. And so people have been trying to find ways around these restrictions, and the shadow banking system is one way of trying to provide credit, even in the face of the central government's attempt to rein in inflation.
My understanding is that a lot of the security, a big chunk of the security for these bank loans is in fact property. We do hear talk about a Chinese property bubble. In your view, things could go wrong because it's all driven by the primary market. Is that right?
That's right. The problem in the Chinese property market is that, in addition to the normal source of demand, people want to buy homes to live in them. There's also another source of demand, which is people are buying multiple units. They're buying them, but they're keeping them empty, and they're holding them as a store of value, like gold. And as long as people are willing to hold them, that's fine. But one thing that's been happening over the course of the past year has been the government's concerned about the unaffordability of housing, because you've got all these investors bidding up the price of housing. And so they've been trying to cool the market. But real estate developers have tried to outlast the government. They've been continuing to build, they've been stocking up inventory, and now with this credit tightening, a lot of them are starting to hit the wall in terms of they don't have any more financing available to them. They have to liquidate properties. When they start liquidating properties, they start discounting.
I presume the secondary market isn't that liquid, the homeowner-to-homeowner market.
That's right. They're all pricing, all these people who are holding properties in China, they're all looking at the primary market, the developer market, and they're pricing off of that. And they think they've got a store of value, but if prices start to go down, they might try to unload, and then you've got a real problem on your hands. Prices could really take a turn for the worse.
Should we then believe the China growth story? We talked earlier about perhaps a credibility gap when it comes to banking and what banks are actually reporting and what perhaps their situation actually is. Late last year, we had the WikiLeaks revealing that perhaps the Chinese GDP figures were a bit more rubbery than they might otherwise have appeared. How much of a concern is this?
The fundamental problem in China is that the growth model that they've embraced over the past 2 years to boost up their GDP is not sustainable. It's investing, it's basically throwing money out the door at investments, whether they're good or bad, counting it as GDP, and then printing money to fund it. Now, that can boost your GDP up for a while, but that's not a healthy economy. That's an economy on steroids. And ultimately, those losses are going to come due, and inflation is going to start to rear its head. And we start to see those cracks emerging, and that's what's making people nervous about the banks, and it's making people nervous about the broader economy.
Briefly, Professor, do you see much impact from Europe and from America and their various dramas?
Well, it just complicates the matter. You know, I think that China is on its own story arc that really came from the stimulus effort that it engaged in and all this lending binge. But the fact that they're not going to be able to necessarily earn their way out of it through exports complicates it. It accentuates the dilemma that they're in. And so it's caused a lot of people to focus on the underlying problems in the Chinese economy.
Very, very interesting times. Professor Patrick Chovanec, thank you very much for joining us tonight.